Commercial underwriting and cap rate analysis. Many new commercial real estate investors are unsure how to properly evaluate a property's financials. They struggle with concepts like net operating income, NOI, cap rate, and yield, and often overlook critical details in underwriting, leading to poor investment decisions or unexpected risks. But by mastering commercial underwriting and cap rate analysis, you will gain the confidence to assess deals accurately, compare opportunities, and negotiate from a position of strength. This skill set is essential for building a profitable portfolio, whether you are analyzing a suburban Dallas office building or a Dubai warehouse. Let us now do a step by step guide to commercial underwriting and cap rate analysis, where we will understand the key metrics, follow the underwriting process, and apply to real examples. Starting with net operating income, NOI. It is gross rental income minus operating expenses. That's not net operating income, excluding the debt service and taxes. This is the core measure of a property's profitability. Sorry. So next is net effective rent. This is the average rent received after accounting for concessions, free rent, and other incentives. Then you have cap rate versus yield. Cap rate is NOI divided by purchase price, used to compare the relative value of different properties. And yield often refers to the actual cash return to the investor, factoring in leverage and other variables. Next is the underwriting process. Review the rent roll, list all tenants, lease terms, rental rates, and expiration dates. Assess CAM charges, common area maintenance charges. Identify which expenses are reimbursed by tenants and which are landlord's responsibility. Apply vacancy assumptions. Use market data to estimate realistic vacancy rate, example 10% for suburban Dallas offices. Calculate NOI. Subtract all operating expenses, including vacancy loss and unreimbursed CAM, from gross income. Determine the cap rate. Divide the stabilized NOI by the property's purchase price. So let's do a practical example of a Dallas suburban office building. The inputs could be gross scheduled rent, $250,000 per year. Vacancy assumption is 10%, that comes to $25,000. Net effective rent is $225,000. CAM charge is $30,000, that's the landlord share, and other operating expenses are $45,000. NOI calculation is 225,000 minus 30,000 minus 45,000 is equal to 150,000. That's my net operating income. The cap rate would be $150,000 divided by 1,875,000. So $1.8 million. If the purchase price is $1.875 million. And that gives us the cap rate. Cap rate is a market comparison tool, whereas yield may be higher or lower depending on financing and other factors. So yield is an actual investor return, cap rate is a market comparison tool. Some tools and best practices. Use financial analysis software or templates to streamline calculations and reduce errors. Always verify market assumptions with recent sales and lease comparables. Consider using AI-powered underwriting tools for faster and more accurate analysis. Don't forget to ask ChatGPT to create a one-page commercial underwriting summary template, including key metrics such as NOI, cap rate, rent roll, CAM charges, vacancy assumptions, and market comparables. Accurate underwriting and cap rate analysis are the foundation of successful commercial real estate investing. By understanding NOI, net effective rent, and the difference between cap rate and yield, you'll make smarter data-driven decisions and avoid costly mistakes. So make sure that you download or build your own underwriting summary template. Practice underwriting a real property. Start with the Dallas office example or a property in your target market. And why? Use ChatGPT or underwriting software to streamline your next deal analysis. And in the next lecture, we'll explore advanced risk assessment and stress testing your assumptions for even greater investment confidence. See you there.